What's going on, guys? Today I'm going to be running us down through a trade that I took yesterday on the 29th of July. I'm going to be essentially doing a trade recap here, discussing with you my whole thought process from the start of the trade all the way to the end of the trade and the decisions behind the trade and why I took them. So let's get right into the video. Alright, so the first thing that I ever want to see before I even look for a trade is I want to see some sort of sell side or buy side liquidity get swept. I need to see a sweep of liquidity. And in this case, we have London highs to the left of us here that still hasn't got swept yet. And as soon as 9:30 open, New York AM open, we do see that sweep of liquidity occur. We see that New York just took out previous session highs, which is London highs. So as soon as we get that buy side liquidity level swept, now I'm looking for shorts. And the reason why I'm looking for shorts is because liquidity moves the market. As soon as we take out some sort of buy side liquidity, I'm expecting to go short for price to seek some sort of sell side liquidity. So the second thing I'm looking for after we sweep London highs is a swing low to be created. And as we can see right here, we get that swing low right there. And why is this specific swing low? This specific swing low is because it's the latest swing low that we have before we get a market structure shift and displacement. So the third and fourth thing on our list is a market structure shift and displacement. As I just said, we had this swing low get created. Now we get a market structure shift and displacement. And essentially what a market structure shift and displacement is, it's a large down close candle that closes below this swing low. It is large and clear, which emphasizes that price is willing to seek lower prices. Now, this is just pretty much telling us that price now is finished going up and now it's wanting to go down. After that, we get a fair value gap. Usually with a market structure shift and a displacement, we get a fair value gap. A fair value gap is essentially a 3-candle pattern. And in this scenario where we have the first candle's low and the third candle's high are not overlapping. And therefore we have an inefficiency, which is just called a fair value gap. Very simple, very, very simple. Now, the sixth thing on our list right here is a retracement into that fair value gap. And that retracement right here, as you can see, that is going to be considered to be our entry. As soon as price retraces to the edge of that fair value gap, we execute the trade, going short in this scenario. We don't wait for price to retrace all the way to the middle or the top of the fair value gap, because as you can see in this scenario right here as well, we don't even get to that point. And if we do wait for those retracements to get a better entry, then simply we'll miss out on the trade. So as soon as price retraces onto the edge of that fair value gap, we execute and go short. Now, as soon as we execute, number 8 on our list is going to be where to place our stop loss. Our stop loss always goes above the nearest swing high. And in this example, our nearest swing high is going to cover 27.5 handles, which is perfect because we're only risking maximum of 30 handles per trade. So that is a perfect stop loss placement. Now, the ninth thing is, what are we targeting? We have to be targeting something, right? So we have all these low resistance liquidities right here. This is all going to be considered to be as low resistance liquidity. So price is most likely going to come take out 1, 2, and 3 of these liquidity levels. So in this scenario, we do target their lowest swing low, which is also considered to be minor sell side liquidity. And as we can see, price plays out very well, bagging around 52.5 handles and risking 27 handles, which is going to be a 1 to 2 pretty much risk to reward. So there you have it, guys. Very, very simple. The silver bullet model. Now, something that I have to talk about and have to include is our entry time. As you can see, our entry time is from 9:45 to 10:15. We executed the trade right on 9:45, as you can see right here. This is very important because this is the first AM macro. And as I mentioned in the past video, if you guys haven't checked that one out yet, go check it out. In the last video, I emphasized that it's very important to take your trades inside of the first AM macro, which is from 9:45 to 10:15, or the second AM macro, which is from 10:45 to 11:15. And the reason being is because there is a higher probability chance of the trade panning out in your favor. So there you have it, guys, the ICT silver bullet model. Very simple, very clear. Now, if you guys got any questions at all, just drop them down in the comment section below and I'll be sure to answer them. And if you guys gained anything out of this video, again, just drop them down. Let me know what you gained. Also, guys, be sure to join the free Discord. I'll put the link down below. I also offer a Discord with live trade signals, trade recaps, trade breakdowns, daily bias, psychology tips, my strategy, and a lot of beneficial things for you guys as traders. So if you guys do wish to join the top trading floor live signals group, I will put the link in the description below. Peace out, guys.